Lunch as buyout machine continues to roll on full steam. Private equity firms are eager to close the year, maybe with even more deals on the books. Who are the likely targets, and what do you look for in a proposed mergers and acquisitions candidate? We'll talk to an expert about that coming up after this.
You're watching CNBC, first in business worldwide.
Listen to this. The total value of mergers and acquisitions deals globally this year right now stands at an all-time high of $3.6 trillion. And while M&A buyout volume hit a record $565 billion, roughly 17% of all the year's M&A activity, we're wondering, with billions more in capital just burning a hole in private equity firms' pockets, we're wondering if it's going to continue through the end of the year. That's only 3 days left. Our next guest says the buyout tally could go even higher before the calendar turns a page. Joining us, Roger Aguinaldo. He's CEO and publisher of the monthly newsletter M&A Advisor. Roger, good to see you again. Welcome back.
Hi, Bill. How are you?
Good. Why is all this happening right now? Why are we talking about all the private equity firms? Why are they spending so much money these days? What's going on?
Well, I think it's really what's called, in our opinion at the M&A Advisor, a perfect storm for M&A deals. You have low relative interest rates. You have a strong economy. You have private equity and corporations flush with cash. And then on top of all that, you have liquid capital markets. You have banks with a lot of money willing to put money into all of these acquisitions to finance these deals.
Is there an advantage to get the deals done before the end of the year?
Now, you know, I think the private equity firms are looking at more of the longer-term horizon than just at any looking at December 31st at the end of the year. But banks certainly have an incentive to close things out for their end of the year, so they may give attractive structures for private equity if they're apt to do deals by the end of the year.
It has happened along a full spectrum of sectors. There hasn't been a real concentration in any one sector. Again, why is that, do you think?
A lot has to do with the availability of capital that these private equity firms have. They've raised in 2005 about 5 times more than venture capital funds. So 4 or 5 years earlier, it was even 50-50. But now private equity firms, this is where a lot of institutional investors, pension funds, a lot of those institutional investors have been putting all of their money in. You know, and then you could see the chart there where Goldman Sachs, Blackstone, Carlyle, they are all charged with, by their institutional investors, to find transactions very quickly in possibly a 3 to 5 year time horizon.
So in order to invest like a private equity investor, you need to think like they do, and you need to look for the things that they look for in a buyout candidate. What are those things? What are the criteria in your view?
Right. Well, the M&A Advisor, we've taken a look at a lot of what private equity funds look at, and they're looking at industries that are mature and consolidating, that the companies have cash flow or EBITDA, earnings before interest, taxes, depreciation, and amortization, that are consistent. You're not going to see private equity companies investing in companies that are losing money, for instance. In addition, they have assets on their balance sheets that are undervalued, much like real estate or divisions that they started internally that on their books don't have a high valuation, but in the market would have a high valuation. And the reason why they would probably want to sell those is to pay down their debt.
A lot of industries out there sitting on a lot of valuable real estate, for example, aren't they?
Right. Yeah. Right. Well, Harrah's Entertainment, which was announced by Texas Pacific Group, has real estate that is not fully valued on their books, and that makes it very attractive to the private equity companies.
Very interesting. Roger, thank you. Happy New Year.